Okay, so this is a um, analysis of a business for Integrity Capital. We have Mike Park with Mountain American Credit Union who's going to train us on how to size up a company's balance sheet, the ratios they look at, what's really important for us to understand and assess so we can see if it's something that we can work forward. So thanks, Mike, for joining us today.
Thank you for having me.
So why don't you take the helm, my friend?
Awesome. All right. So the first page on this PDF here is just a sample balance sheet. And not every balance sheet is going to be the same. You're going to have certain ones depending on the industry and what they do, but it's going to have the main components in there: assets, liabilities, and owner's equity.
So just for someone, if they're newer, so assets are everything they own, right? Cash is the breakdown. You have kind of current assets, which are shorter term,
within a year. Yep.
Within a year or less. Anything that is a long-term asset is something that could be a year or more, essentially. And then intangible is like, just like it sounds, non-tangible, goodwill,
blue sky.
Yeah,
use that way.
Right. Sometimes. And then the liability side is just what they owe. So it's an obligation to either, again, short-term, less than a year, wages, notes payable, accounts payable versus long-term liabilities. And then so the equation is that assets equals liabilities minus owner's equity, right?
Plus
owner's equity.
Yeah,
that's right.
The old accounting classes.
Yeah, correct. So assets equals liabilities plus owner's equity. So there you go.
Very good. So this, like I said, the first page is this kind of a templated balance sheet, and then into page 2 and on is we kind of go over the different type of ratios. There's quite a few of them: liquidity, there's profitability, debt ratios, interest cover, efficiency ratios, probably much more than you need. The ones that I really focus on is the current ratio or quick ratio.
Okay.
And the reason behind that is, if we kind of read what it means. The current ratio measures a company's ability to pay its short-term liabilities with its short-term assets. So short-term assets are the assets that are extremely liquid, cash, right? They can quickly, pay debts. And so really the main difference between these two ratios, the current and quick ratio, is the quick ratio, we subtract out inventory because we anticipate inventory will take a few weeks to month, depending on the industry, the company that you're dealing with, and what their inventory is. So if it's something like steel cylinders that roll up wire or something like that, and they sell it internationally, who knows how long it takes for them to sell something like that. So I really like to look at the quick ratio. And so basically it's the same as the current ratio, but we just subtract out that inventory cost. And essentially what we're looking the ratio to be is greater than 1. So the equation there is current assets minus inventory divided by the current liabilities.
So if it's 1 to 1, what is that saying to us?
It's just saying that they have, for every dollar of debt, current liabilities that they plan to pay within the year, they have $1 of current assets to pay at. So
if they had 0.6, that means they'd have negative, meaning they would only have 60 cents to pay every dollar.
Right.
If they have a 1.2, then they'd have $1.25 to pay every dollar.
Right. So this gives you a quick, and obviously another thing too to think about is, David mentioned that you guys looked at an income statement, right? And that's just the revenues and, expenses and all that stuff. A balance sheet is a snapshot in time. right? And so with a very current balance sheet as of, let's say, today, that gives you an instant snapshot of what the health of their company is. So when, as a lender, we want to look at that and say, okay, if like Dave said, if we do this ratio and they're at a 0.6, I know that they're hurting for cash, right? And there's something not quite right, especially if you look at if you did the current ratio and they're at 0.6, because that's including their inventory. So you can take that with discretion as like one would be worse than the other depending on what situation they're in,
So a balance sheet, in a sense, so it's a snapshot of time where a profit and loss statement is a period of time, right? So January to, December, where balance sheet is just saying, it's like taking a photo. Here's where you're at right now. This is what's going on today in your company.
And it's important too and there's stories behind it too, because I've dealt with companies like a company that has gone and had a bunch of cash, went out and spent $2 million on inventory or materials to create an inventory. And so when you if you were to look at the quick ratio on him, it's way low. But what he was doing is, and as long as there's a story, and that's the nice thing about commercial lending underwriters, you can usually create a story. There's a little more gray area. And so for that particular borrower, he went out and spent like $2 million on inventory. So his current ratio was, his quick ratio wasn't very good because he just dumped a bunch of money into his company, right, to buy the inventory. But the current ratio was good because that's the one that that's why it's good to kind of decipher which one you want to use, and then you can tell a story behind it. So, obviously the underwriter was like, well, why does he have so much inventory? So that just generates more questions. Well, he wanted to capitalize on a discount to rate by buying gold, and so, which in turn increases his profit margins, right? Because he can now generate, obviously income with less expense.
That's good.
So these are all very important when it comes to, looking at the balance sheet. Again, I've kind of comprised in here just an explanation of all these different.
So if you consider liquidity ratios, and then what are these up here?
Liquidity up here is we have profitability ratios, just return on assets. And the formula is right there. It's net income divided by average total assets, and so basically what that means, a company could buys assets in order to conduct its business. Return on asset tells you how good the company is at using those assets, right? So
the formula, we take the net income for 12 months.
Well, you can do it if you have a sample period, and whatever that sample period is, you can annualize it by just dividing it by the sample period and then multiplying it by 12.
And then you take the average total assets then?
Yeah.
So you take the snapshot of the 12-month, or just how do you determine that?
So or whatever you do it consistently on each side. So if you only have a 6-month period of data from your income statement, so if it's an interim, right, then you would just use that. Right.
Okay.
And try to get that same balance sheet.
Got it.
Period snapshot.
Okay. And then return on equity.
Okay. So it equals net income divided by average stockholder equity. So it can be challenging if it's not a corporation, right?
Yeah.
But essentially it's equity is another word for ownership, right? And so that's so return on equity tells you how good the company is at rewarding its owner, right? And so this can be challenging too, because if depending on the owner, if he just has a bunch of retained earnings, and not distributing and things like that, it just tells you how much equity is actually in the company. So, and then profit margins, right?
Net income to
Sales, right?
It's telling you kind of the percentage that's hitting the bottom line.
Right. So you'll see, throughout your career here, you'll see, there's some, bookkeepers or CPAs that with their statements will actually have another column that has percentage, and that's very helpful because then you can kind of look at what those are. So when it says net income, or it'll tell a percentage based on all the different parameters, whether it be their sales and different cost of goods sold and things like that. They calculate it out automatically. Those are nice. I like getting those.
Yes, I know. It is.
So we get liquidity,
And
debt ratio. This here is these ratios concentrate on long-term health of the business. So, the main ones I really look at are the, like I said, the current and quick, and that's for short term. So the debt ratios helps look at the long-term health of the business. Personally, or generally the effect of the capital and finance structure of the business. So debt to equity ratio.
what do you want to see? I mean, what's like a healthy?
So I don't actually dive into the weeds of this one. I generally let the underwriters go through this, and quite frankly, some of them don't even do it to get into this far of it. I mean, I know the larger institutions, Chase, when I was at Chase, we did this, but they have a lot more overhead, so they have to be very meticulous. My particular employer, so Mountain America Credit Union, we're a cash flow and collateral lender, right? So if we can quickly see that the property or the business is able to cash flow historically, and in the current year, and then the collateral is sufficient, we don't really. Yeah. So, but yeah. So this one, I mean, like I said, it's pretty self-explanatory. I think.
What's the interest coverage ratio?
Where are we at here? So interest coverage ratio is EBITDA, so earnings before interest and taxes divided by interest expense, kind of separates that interest.
What is that telling? I'm just trying to see what's that telling us.
So
times interest
earned is a measure of how well the company can meet its interest obligations. So, so if their debt is bleeding them dry, essentially, and the cost of it.
Okay.
So.
Got it.
And then efficiency ratio, so asset turnover ratio. These are really just investors' insight how effectively a business is employing its resources. So the formula is right there. The asset turnover ratio tells you how good the company is using assets to produce, to make products to sell.
Okay.
So not every one of these is necessary, I think, for if you're dealing with a deal that's just a true investment deal where you're looking at just a property. A lot of these things won't make sense, but if you're dealing with a operating company that especially manufactures something or produces a product or service, these will be necessary. Inventory turnover ratio is just how quickly they're able to turn inventory.
Got it.
So that's the main things that we'll look at.
Okay.
But I'd say most of the time that I spend is in the quick ratio and ratio. Those are the things that I use the mostly. And so I think next is we'll kind of segue and we can look at a couple different tax returns. We want to look at, if you have a sample. I don't have any.
Let me pull something up.
Something that we can.